All right, let's get straight to it. Today isn't about adding some new fancy technique or a secret indicator to your charts. It's actually the opposite. We're going to focus on removing the bad thinking habits that cause most traders to fail. It's all about what not to do. So let's tackle the big question right away. Why do most traders fail? I mean, really, why? The common answer you hear is, oh, I just haven't found the right strategy, or I missed the perfect entry signal. But that's usually not the real reason. The truth is, it's rarely about a lack of knowledge. The real problem? It's a lack of discipline. It's these flawed ways of thinking that we all have, and they end up sabotaging even a perfectly good strategy. Okay, so let's dive right in. We're going to break down the 6 most common thinking traps. These are the specific beliefs that, time and time again, lead directly to losses. All right, trap number 1, trading breakouts blindly. You know the feeling, right? You see a price smash through a resistance level and you think, this is it, it's gonna run. But the harsh reality is that most breakouts fail. They're what we call traps for a reason. They suck in late, emotional buyers right before the price slams back down. Honestly, trading them well takes a level of skill that beginners just don't have yet. So here's your first rule, and it's an absolute. While you're in this learning phase, you will not trade breakouts. Period. This isn't up for debate. It's completely non-negotiable. Okay, on to trap number 2, fearing all-time highs. This is a classic beginner mistake. You see a stock at a price it's never hit before, and your brain screams, whoa, that's way too high, it's gotta fall now. But you have to flip that thinking around. An all-time high is actually a sign of incredible strength, not weakness. The whole point of a strong trend is to keep making new highs. ATH is just a label, not some magic wall in the sky. And that brings us to your next rule. Structure decides everything. The only thing that matters is the actual pattern of higher highs and higher lows, or lower highs and lower lows. That's it. You have to learn to ignore those emotional labels like all-time high. A price is just a number. The structure is the story. Trap number 3 is a big one, trying to predict reversals. You see a stock that's been falling hard, and you think, it's dropped so much, it has to bounce from here. Look, the market doesn't care what you think is cheap or fair. It has zero obligation to bounce just because you think it should. This is what we call trying to catch a falling knife, and it's a game of prediction, not analysis. So your rule is simple. No predictions. I want you to literally remove these words from your trading vocabulary: will, should, and looks like. We don't guess. We wait for the market to actually prove a reversal has happened, and only then do we react to that new information. Next up, trap number 4. This one gets a lot of people. It's scanning the top gainers list every morning. You're basically hunting for excitement, for fast action. But here's the thing. By the time a stock hits that list, the big move is probably already over. You're late to the party, and that's when you end up chasing the price and making dumb emotional decisions. Which leads to this rule: scan for calm. Your goal isn't to find excitement, it's to find clarity. You should be looking for charts that are easy to read, with clean structure and orderly price moves. Seriously, professional trading should kind of be boring. Excitement is your enemy here. Trap number 5, mixing up investing and trading. This is a huge mistake. You might think, oh, this is a great company, so buying the stock here is safe. Wrong. The short-term price of a stock has almost nothing to do with how good the company is. Even the best companies in the world can see their stocks get cut in half. The business fundamentals are totally irrelevant to managing your risk on a short-term trade. So your rule is to define your role and stick to it. An investor asks, is this a good business? A trader asks, is my risk clearly defined here? They're completely different questions. For our purposes, you are a trader. That's your job. And the final trap, number 6, rushing to find an entry. So many beginners spot a support level and instantly start looking for a buy signal. That's completely backward. There's a proper sequence you have to follow, from the top down. 1, identify the trend. 2, identify the market structure. 3, identify your location within that structure. The very last thing you should even think about is the entry. And because that sequence is so important, here's your final rule for now, and it's a tough one. You're not allowed to even think about entries yet. Seriously, for now, your entire focus has to be on that high-level analysis, trend, and structure. That's it. Okay, so now that we've cleared out all those mental traps, we can talk about your real purpose as a trader. And trust me, it's probably not what you think it is. I want you to burn this next sentence into your brain. My job is not to trade. My job is to filter out bad trades. Let that sink in. Your number one skill isn't finding good trades, it's getting really, really good at rejecting bad ones. You are the bouncer at the door of your trading account. So, how do you actually build that skill? Well, you don't build it by placing more trades. You build it by practicing rejection over and over again. You have to train your brain to automatically look for what's wrong with the chart, not what's right.
So here's your assignment. It's simple, it's clear, and it's not optional. Pick 3 large cap stocks. Pull up their weekly and daily charts, nothing else, no indicators. And for each one, your only job is to find and write down at least 2 solid reasons not to trade it.
And this is what that log should look like. See that? Notice what isn't there. There's no entry price, no profit target, nothing about making money. This is purely an exercise in finding flaws. A trend mismatch between the weekly and daily? That's a rejection. The structure just looks messy and confusing? That's a rejection. So finally, how do you measure your progress? How do you know if this is working? It's not by looking at your account balance. The real sign of progress is a complete shift in how you feel when you're looking at the markets. Think about these 2 mindsets. The beginner is all over the place. They're excited, they feel this urgent need to place a trade, they're terrified of missing out. The disciplined trader, on the other hand, is calm. They're confident when they reject a setup, they have zero emotional attachment to any one trade because they trust their filtering process. And let's wrap up with this key idea. Deciding not to trade is not a failure. It's not passive. It is an active, strategic decision. In fact, it's often the most professional move you can make. It's a trade that guarantees you don't lose money. So I'll leave you with this question to think about. After going through all of this, how do you feel right now? Do you feel more excited and antsy to go find a trade? Or do you feel calmer, more empowered by the idea of rejecting trades? Your honest answer to that question tells you everything you need to know about whether you're on the right path.